All right, let's jump into a deep dive on Regulation O,
Okay.
specifically for you FDIC examiners out there.
Right.
We're going to tackle this beast from a technical examination perspective.
Yeah.
Because let's face it, this
Mhm.
regulation is full of definitions and
Ah.
intricacies that can make your head spin.
For sure. Absolutely.
You're absolutely right.
So knowing the ins and outs of Regulation O
Mm-hmm.
is critical for examiners, right?
Absolutely.
I mean, we're talking about making sure loans to insiders are on the up and up.
Right.
No funny business.
Exactly.
And to do that, you need to be fluent
Uh-huh.
in the language of the regulation.
You really do.
Exactly. It's not enough to just know it exists.
Nope.
You've got to be able to apply it during an exam,
Mm-hmm.
spot potential red flags,
Yep.
understand those nuanced exemptions
Mm-hmm.
that can trip people up.
They can.
So to help you navigate those technical aspects,
Mm-hmm.
we'll be unpacking the key definitions,
Right.
examining the wording, and really getting into the nitty-gritty of what examiners need to be looking for.
That's exactly it.
Sounds good.
Yeah.
Now, where should we start with this deep dive?
Let's set the stage with section 215.1, authority, purpose, and scope.
Okay.
This lays the legal groundwork for the entire regulation.
Okay, so what are the legal roots of Regulation O?
Okay.
Where does the Fed get the authority to tell banks who they can and can't lend to?
Well, Regulation O is rooted in several federal laws.
Uh-huh.
Think the Federal Reserve Act,
Okay.
FDICIA, Homeowners Loan Act,
Okay.
and even parts of the Dodd-Frank Act.
Wow, a lot of different.
These laws
Yeah.
give the Federal Reserve the power to regulate extensions of credit from member banks to their insiders.
Okay, so it's not just some arbitrary rule.
Yep.
It's got some serious legal muscle behind it.
It does.
Absolutely.
Yeah.
Now, as for the purpose,
Mm-hmm.
it boils down to preventing bank insiders from abusing their positions
Right.
to get favorable loans.
Right.
We want to ensure a level playing field,
Uh-huh.
protect the bank, and by extension, the whole financial system
Right.
from undue risks.
Exactly.
That makes perfect sense.
Yep. Yep.
So who exactly are we talking about here?
Okay.
Who falls under the scope of Regulation O?
Regulation O applies to member banks
Mhm.
when they're lending to their own insiders.
Okay.
But here's the catch. It also covers lending to insiders of a bank's affiliates
Mhm.
and even subsidiaries of the parent company.
Oh, wow.
Think complex corporate structures,
In
holding companies, that sort of thing.
Wow, so we're talking about a whole web of potential insiders here.
We are.
This is where it can get really tricky during an exam, right?
Yes.
You hit the nail on the head.
Mm-hmm.
That's why Section 215.2 definition
Yes.
is absolutely crucial for examiners.
No, absolutely.
It's like the dictionary for Regulation O,
It is.
and you need to know every word by heart.
You really do.
All right, let's crack open that dictionary then.
Okay.
Where do we start?
Let's tackle affiliate first.
Okay.
This one is all about relationships between companies.
Right.
That affiliate is any company that the member bank is a subsidiary of,
Mhm.
or any company that is a subsidiary of the same company that the member bank is a subsidiary of.
Okay, so
Yeah.
if Bank A is a subsidiary of Holding Company X,
Right.
and Company B is also a subsidiary of Holding Company X,
Mhm.
then Bank A and Company B are considered affiliates under Regulation O.
That's exactly right.
Okay,
Think of it like a family tree of companies.
got it.
Okay.
What about company?
Mhm.
That seems pretty straightforward.
It might seem that way,
Yeah.
but there are some specifics you need to know.
Okay.
A company under Regulation O
Uh-huh.
includes pretty much any type of business organization,
Mhm.
whether it's a corporation, partnership, association, business trust, or similar organization.
Okay, so basically any entity engaged in business activities.
Yes,
Okay.
but with a couple of key exceptions.
All right, what are those?
Insured depository institutions,
Okay.
think other banks,
Okay.
are specifically excluded from the definition of company under Regulation O.
Okay.
Also, corporations that are majority owned by the U.S. or a state government aren't considered companies either.
Interesting. So it's really targeting those
Mhm.
private companies
Yeah.
where insiders might have more sway.
Precisely.
Okay.
Now, this is where things get a little more complex. The definition of control.
Okay.
This is a big one
Yeah.
because it determines who falls under Regulation O's umbrella.
Okay, I'm ready for this. How does Regulation O define control?
There are three ways control can be determined.
Okay.
The first is straight up ownership.
Okay.
Owning, controlling, or having the power to vote.
Mm.
25% or more of any class of voting securities of a company.
So if someone owns a quarter of the company's voting stock,
Mm-hmm.
they're automatically considered in control.
Right.
What are the other two ways?
The second way is through board control, controlling the election of a majority of the directors of a company.
So even if someone doesn't own a ton of stock, they could still be in control if they can essentially handpick the board of directors.
Exactly.
Okay, and the third way?
And the third way is having the power to exercise a controlling influence
Okay.
over the management or policies of a company.
So it's not just about formal ownership
Right.
or board seats. It's about real decision-making power,
Yes.
even if it's behind the scenes.
You got it.
Now,
Here's where things get a bit more nuanced.
okay,
There's a presumption of control.
okay.
If someone is both an executive officer or director of a company and owns, controls, or has the power to vote
Okay.
more than 10% of any class of voting securities.
Okay, so if you're a high-ranking official and a significant shareholder, there's a good chance you're considered in control.
Right.
But it's not automatic.
Right. There's also a presumption of control if someone owns more than 10% of the voting stock
Okay.
and no other person owns a larger percentage.
Okay.
But again, it's just a presumption.
So how can someone challenge that presumption of control?
They can submit evidence to the appropriate federal banking agency,
Okay.
demonstrating that they don't actually have control,
Okay.
even if they meet those ownership or position thresholds.
Okay.
It's all about proving that they don't have that ultimate decision-making power.
Okay, so there's a process for pushing back on that presumption.
Right.
That's good to know.
Yeah.
What's next on our definition list?
Let's move on to director.
Okay.
Seems straightforward, right?
Yeah, that one seems pretty clear-cut.
It's anyone who serves on the board of directors of a company,
Yeah.
regardless of whether they're compensated for their services.
Is there a catch?
Well,
Okay.
there's a specific type of director called an advisory director.
Okay.
They're different because they don't have voting rights on the board. They can't be involved in the company's major policy-making functions. Think of them more like high-level consultants to the board.
Interesting.
Yeah.
So are advisory directors automatically excluded from Regulation O?
Not necessarily. They're still considered directors.
Okay.
But there is a specific exemption
Okay.
for extensions of credit to a director of an affiliate.
An exemption.
Yes.
Tell me more. So,
under section 215.4, 215.6, and 215.8,
okay.
extensions of credit to a director of an affiliate are exempt if certain conditions are met.
What are those conditions?
First, the board of directors has to officially exclude that director from participating in major policymaking functions.
Okay.
And we're not talking about just saying so. The
Right.
director can't actually participate in those functions.
No backdoor influence or
Right.
anything like that.
Yeah.
What's the second condition?
The affiliate can't be in a position to control the member bank.
Okay.
Remember that definition of control we discussed earlier?
Yeah. I'm starting to see how all these definitions are interconnected.
Mm-hmm.
What's next?
The affiliate's assets can't be more than 10% of the consolidated assets of the company that controls the bank
Okay.
and isn't controlled by any other company.
Okay. So there are limits on the size and influence of the affiliate.
Right.
Is there a final condition?
Yes.
Okay.
The director can't be subject to those sections for any other reason.
Okay. So it's a pretty narrow exemption with lots of caveats.
Yeah.
Wow. That's a lot of hoops to jump through.
Yeah.
It seems like examiners really need to scrutinize those affiliate relationships and make sure all the boxes are checked before applying that exemption.
You're absolutely right.
Now let's move on to executive officer.
Okay.
This one can be a little tricky. Why is that?
It's not just about titles.
Yeah.
It's about their role in the company. An executive officer is anyone who participates or has the authority to participate,
Okay.
other than in the capacity of a director, in major policy-making functions of the company.
Okay, so a vice president who's just a figurehead might not actually be considered an executive officer
Right.
for Regulation O purposes.
Exactly.
It's about real authority and decision-making power.
It is.
Now, there are certain positions that are presumed to be executive officers unless the board specifically excludes them
Yeah.
from those major policy-making functions.
Yes.
Okay, so we're talking about positions like chairman of the board, president,
Yes.
every
Yeah.
vice president,
Every vice president.
the cashier, the secretary, and the treasurer,
You got it.
unless the board specifically excludes them.
Right.
Now, just like with directors of affiliates, there's an exemption for lending to executive officers of affiliates
Yes.
if similar conditions are met.
Right.
Those 4 conditions we just went through.
Correct.
Okay, so I'm seeing a pattern here. a lot of these definitions have these specific exemptions for affiliates built in. It seems like examiners really need to be mindful of those affiliate relationships.
You're catching on.
Yeah.
Those exemptions can make a big difference in how Regulation O is applied.
Yeah.
So it's important to know the rules inside and out.
All right, let's keep going with those definitions.
Okay.
What's next?
Well, we have a few more to cover in this section.
Okay.
Foreign bank has the same meaning given to it in 12 U.S.C. 310117.
Okay.
Next is immediate family, which, for Regulation O purposes, includes a person's spouse, minor children, and any children, regardless of age, who are living in the person's home.
All right, so we're talking about a pretty traditional definition of immediate family there.
Yes.
What about insider?
Insider is a key term because it encompasses all the folks we've been talking about so far.
Okay.
It includes any executive officer, director, or principal shareholder of a member bank, or any of their related interests.
So insider is like the umbrella term for all the potential individuals who could use their influence to get favorable treatment from the bank.
Exactly.
Okay, what's next?
Next is lending limit.
Okay.
Which is the absolute maximum amount a member bank is allowed to lend to a single borrower.
Okay.
This limit is directly tied to the bank's capital and surplus and is determined by the somewhat complicated calculation outlined in Section 215.2I.
Okay, so bigger banks with more capital have higher lending limits.
That's the general idea.
Okay.
For most banks, the calculation is a bit of a mouthful. 15% of the bank's unimpaired Tier 1 capital, plus 25% of the bank's unimpaired Tier 2 capital, plus 100% of the bank's allowance for loan and lease losses, or 100% of the bank's adjusted allowance for credit losses, depending on which one the bank is required to maintain.
Wow, that's a lot of moving parts.
There are also special considerations for smaller banks that are subject to the Community Bank Leverage Ratio framework. For those qualifying community banking organizations, the lending limit is calculated as 10% of the sum of the bank's unimpaired Tier 1 capital, plus the allowance for loan and lease losses, or the adjusted allowance for credit losses, again, depending on which one the bank is required to maintain.
Okay, it seems like examiners need to be really familiar with these different calculations and know which one to apply in each situation.
Absolutely.
Okay, what's next?
Member bank is another important one.
Okay.
It simply means any domestic bank that is a member of the Federal Reserve System.
Okay, that makes sense. What about pay an overdraft? That one seems pretty self-explanatory.
You'd think so.
Yeah.
But there are a few things to keep in mind.
Right.
Pay an overdraft means to pay a check or other draft drawn on the member bank by an overdrawing customer when the customer's account does not contain sufficient funds to cover the amount of the check or draft.
So it's not just about letting a check go through. When the account is empty, there has to be an actual overdraft situation.
Exactly.
Okay.
Nuances are important here.
Okay.
Now, person is a broad term that encompasses both individuals and companies.
Okay.
And then we have principal shareholder.
Okay, principal shareholder. So someone who owns a large chunk of the bank's stock.
Yes, but there's a specific threshold.
Yeah.
A principal shareholder is any person who owns, controls, or has the power to vote more than 10% of any class of voting securities of a member bank or any company.
Okay.
And here's a key point. Shares owned or controlled by the person's immediate family members are counted towards that 10% threshold.
So you can't just try to skirt the rules by spreading ownership among family members.
Exactly.
The regulators are one step ahead.
They are. Related interest is another term that's all about connections and potential influence. It means 1, any company controlled by a person. 2, any political or campaign committee that is controlled by a person or the funds or services of which will benefit a person.
Okay, so it's capturing a wide range of entities that could be used to exert influence or funnel benefits to an insider.
Precisely.
Okay.
But it's important to note that neither a bank nor a foreign bank is considered a related interest.
Okay, good distinction.
And finally, subsidiary has the meaning defined in 12 U.S.C. 1841 but does not include subsidiaries of a member bank.
Okay, we just plowed through a whole lot of definitions there.
We did.
I'm starting to feel like I'm speaking fluent Regulation O now.
Great. Understanding these definitions is crucial for applying the regulation correctly.
Right.
Next, we'll delve into what actions constitute an extension of credit under Section 215.3. And that's where things really start to get interesting from an examiner's perspective.
Okay.
Yeah.
Perfect.
All right, so you ready to jump into section 215.3?
Let's do it.
This is where we define extension of credit. And this is really where the rubber meets the road for examiners.
Yeah.
Because it lays out what actions actually trigger regulation. Oh!
Yeah, I have a feeling this is going to be more than just your typical loan.
You bet.
What other ways
Yeah.
can a bank extend credit to an insider that we need to watch out for?
The regulation lists out several scenarios
Good.
that fall under the definition of extension of credit, and examiners need to be aware of all of them.
Okay, give me some examples. What are we looking for here?
Well, purchasing securities or other assets
Okay.
under a repurchase agreement
Okay.
counts as an extension of credit.
So even if the bank isn't directly handing over cash,
Exactly.
these repurchase agreements can still be used to funnel money to insiders.
Exactly. And remember, anything that puts the bank at risk for an insider's benefit can be considered an extension of credit.
Okay.
So advances through overdrafts,
Okay.
cash items, or other means are on the watch list.
So we need to be scrutinizing any unusual transactions
Yes.
where the bank is essentially covering an insider's expenses or debts.
You got it.
Okay.
Examiners should also be on the lookout for things
Okay.
like issuing a standby letter of credit
Okay.
or an ineligible acceptance on behalf of an insider.
Those sound a little more complex.
Here.
Could you give me an example of how those might be used
Yeah.
to benefit an insider?
Imagine a bank issues a standby letter of credit
Okay.
to back up a loan an insider is getting from another institution.
Okay.
If the insider can't repay that loan, guess who's on the hook?
The bank.
The bank.
I see.
That's an extension of credit, even though they didn't directly make the loan.
So it's not just about direct lending.
Right.
It's about the bank assuming risk
Mm-hmm.
on behalf of an insider, regardless of the specific financial instrument used.
Precisely.
I see.
Here's another scenario.
Okay.
Acquiring any debt
Okay.
where an insider is personally liable.
Okay.
This could be as the maker, drawer, endorser, or guarantor of the debt.
So if a bank buys a loan that an insider has guaranteed,
Exactly.
that would fall under Regulation O.
Exactly. It's all about that connection to the insider
Okay.
and the bank's potential exposure.
Yeah.
And it's not just about creating new debt.
Uh-huh.
Increasing an existing indebtedness
Okay.
also counts as an extension of credit.
Okay, so a bank can't just keep increasing an insider's line of credit
Right.
without triggering Regulation O scrutiny.
Right. There's an exception, though.
Okay.
If the bank is simply advancing funds
Okay.
to cover things like accrued interest, taxes, insurance, or other expenses directly related to the original debt.
So routine loan maintenance activities
Right.
wouldn't raise red flags.
Correct.
But any significant increases in the principal amount owed would require close examination.
Absolutely.
Okay.
And here's another one that can trip people up.
Okay.
Advances of unearned salary or compensation for a period longer than 30 days.
So no big bonuses
Right.
paid out way in advance,
Uh,
unless it's properly justified and documented.
that's right.
Okay.
Essentially, any transaction that leads to someone owing money to the bank, whether directly or indirectly,
Okay.
needs to be carefully reviewed to see if it qualifies as an extension of credit under Regulation Area O.
All right. So we've covered what is considered an extension of credit.
Right.
What about what's not included?
Okay.
Are there any exceptions examiners should be aware of?
There are.
Okay.
For instance, advances against accrued salary or compensation
Okay.
for a reasonable amount and time period are perfectly fine.
Okay.
Think of your typical paycheck advance. That's not going to raise any eyebrows.
That makes sense.
Mm-hmm.
Routine bank activities like processing checks and deposits
Right.
are also excluded, right?
You got it.
And there's a specific exception for those inadvertent overdrafts under $1,000
Right.
that are repaid promptly.
Mm-hmm.
Okay, so if someone accidentally overdraws their account
Mm-hmm.
by a small amount and fixes it quickly, the bank isn't going to get in trouble.
Right.
What about loans that a bank acquires through a merger
Yeah.
or collateral foreclosure?
Those are generally exempt too,
Okay.
as long as the bank handles them appropriately
Mm-hmm.
and doesn't hold on to that acquired debt for too long.
Okay, so if a bank ends up owning a property after an insider defaults on a loan,
Right.
that wouldn't necessarily trigger Regulation TOA concerns.
Right. As long as they follow the proper procedures
Okay.
for managing and eventually selling that property.
Okay, so there are some common sense exceptions built in,
Mm-hmm.
but it seems like examiners still need to carefully analyze
Mm-hmm.
each transaction
Right.
and not just assume
Mm-hmm.
it's automatically exempt.
You're absolutely right.
Okay.
And there's one more crucial rule we need to discuss.
Okay.
The tangible economic benefit rule.
That sounds intriguing. What's that all about?
This rule recognizes that a loan doesn't have to be directly made to an insider to benefit them. If an insider receives a tangible economic benefit from the proceeds of a loan,
Okay.
even if it's technically made to someone else,
Yeah.
it's still considered an extension of credit to that insider under Regulation O.
So if a bank loans money to a company owned by an insider,
Yes,
and then that insider uses those funds for personal expenses,
exactly.
that would be a big red flag.
Exactly.
Examiners need to trace the flow of funds and make sure the loan proceeds are used for legitimate business purposes.
Mm-hmm.
It's all about substance over form.
It is.
But I'm guessing there's an exception to this rule, too.
You know what?
All right, Amy.
If the loan terms are the same as what the bank offers to non-insiders,
Okay.
and the loan proceeds are used in a genuine transaction to buy goods or services from the insider at fair market value,
Okay.
then it's not considered an extension of credit to the insider.
So an insider could legitimately get a loan to expand their business,
That's right.
for example,
Right.
as long as everything is done above board and at arm's length.
That's right.
Examiners still need to scrutinize these transactions carefully, though.
Yes.
Make sure they're not just clever attempts to funnel money to insiders.
Correct.
All right. I'm starting to get a handle on this extension of credit concept.
Good.
It's clearly much broader than just writing a check.
Yes.
Now that we understand what qualifies as an extension of credit, what are the rules that banks have to follow when dealing with these insider loans?
That's a great question.
Yeah.
And that's exactly what we'll be diving into next.
Okay.
Section 215.4 lays out the general prohibitions that member banks must follow when it comes to insider lending.
Sounds like we're getting to the heart of the matter now.
We are?
So what exactly do these general prohibitions entail?
This section focuses on ensuring that insider lending is conducted fairly transparently and without posing undue risks to the bank.
Okay.
It covers a wide range of requirements, starting with the terms and creditworthiness of the loan itself.
So banks can't just give their buddies sweetheart deals
You got it.
with low interest rates and lax repayment terms.
Regulation O is crystal clear.
Okay.
Loans to insiders must have the same terms,
Okay.
including interest rates, collateral requirements, and other key provisions as comparable loans made to non-insiders.
That makes perfect sense. No special treatment just because you happen to be golfing buddies with the CEO.
Exactly.
What about the underwriting process? Can banks just rubber stamp these insider loans
Absolutely not.
without doing their due diligence?
Regulation O requires banks to apply the same, if not stricter, credit underwriting standards to insider loans as they do to loans for everyone else.
Okay, so they need to verify income, assets, credit history, the whole 9 yards.
That's exactly right.
Okay.
And the loan can't present more than the normal risk of repayment or have other unfavorable features compared to similar loans made to non-insiders.
Okay, so we've established that insider loans need to be on the up and up in terms of terms and creditworthiness. What else do these general prohibitions cover?
Another crucial area for examiners is prior approval.
Okay.
Regulation sets specific thresholds for when insider loans need to be pre-approved by the bank's board of directors.
Okay.
This is a critical safeguard
Yeah.
to prevent self-dealing
Okay.
and ensure independent oversight.
So it's not just a matter of the loan officer signing off on it. There's a higher level of scrutiny involved.
Exactly. Any extension of credit to an insider that exceeds $25,000 or 5% of the bank's unimpaired capital and surplus, whichever is greater, needs to be approved in advance by the full board of directors.
So it's not just about the absolute dollar amount.
Right.
It's also about the relative size of the loan compared to the bank's capital. What about the insider who's applying for the loan?
Yes.
Can they participate in the board's decision-making process?
Not a chance. The regulation is very clear that the interested party, meaning the insider receiving the loan, has to completely abstain from the voting process.
Okay, so no backroom deals or undue influence.
All right.
That makes perfect sense. Is there a ceiling on how much an insider can borrow?
Yes. There's a hard limit of $500,000.
So even if a loan is well below 5% of the bank's capital, that $500,000 cap still comes into play.
That's
It's an absolute ceiling.
It is.
And keep in mind, these approval requirements
Right.
apply not only to individual loans, but also to lines of credit. So even setting up a line of credit for an insider
Yes.
requires careful scrutiny and board oversight.
You got it.
Now, is there...
Now, there is one exception
Okay.
to this pre-approval rule.
Okay.
If the board already approved a line of credit for an insider within the past 14 months,
Okay.
the bank can extend credit under that existing line
Okay.
without having to go back to the board for each individual draw.
Okay, so there's some flexibility there as long as
Right.
the line of credit is relatively recent.
Yes.
Okay.
Now, what about indirect participation? Does that factor into the board approval process?
Yeah, I would imagine so.
It absolutely does.
Yeah.
The regulation specifically prohibits any attempt by an insider to influence the board's decision,
Okay.
even indirectly.
Okay.
This includes participating in discussions or trying to sway other board members behind the scenes.
So examiners should be on the lookout for any signs
Exactly.
of pressure
Right.
or maneuvering by insiders.
Now let's shift gears and talk about individual lending limits.
Right.
Regulation O sets a cap
Okay.
on how much a member bank can lend to any single insider,
Okay.
including all the related interests.
So it's not just about the size of individual loans.
You nailed it.
It's about the total exposure
Exactly.
the bank has to that insider across all transactions.
And as we discussed earlier, this limit is directly tied to the bank's overall lending limit,
Right.
which is based on its capital and surplus.
Okay.
Remember that calculation in Section 215.2I?
Yeah, that was a mouthful.
It was.
So a bank with a higher lending limit
Hmm.
has more leeway to lend to a single insider.
That's the general principle.
Okay.
But it still has to operate within those regulatory boundaries. However, there's an important exception here.
Oh, okay.
This individual lending limit doesn't apply to extensions of credit made to a company
Right.
that the member bank is a subsidiary of, or to any other subsidiary of that same parent company.
So there's a carve-out for lending within a corporate family.
Right.
Makes sense. It's all essentially the same economic entity.
Exactly.
Okay, what about aggregate lending limits?
Okay.
Is there a limit
Yes, there is.
on the total amount a bank can lend to all of its insiders combined?
Regulation OC states that the total outstanding extensions of credit
Okay.
to all insiders
Mhm.
can't exceed the bank's unimpaired capital and surplus.
So it's like a system-wide safeguard
Exactly.
to prevent banks from becoming overly reliant on insider lending
Right.
and potentially putting themselves at risk.
Now, here's where things get a little more nuanced.
Okay.
For smaller member banks with deposits of less than $100 million,
Okay.
there's a provision that allows them to increase that aggregate lending limit to twice their capital and surplus.
Oh, interesting.
Yeah.
So smaller banks get a bit more leeway?
A little bit more leeway.
Why is that?
It's designed to recognize the unique challenges
Okay.
these smaller banks often face, especially in rural communities where lending options might be limited.
Okay.
They might need to rely more heavily on insider lending
Okay.
to support local businesses and economic development.
That makes sense.
Mm-hmm.
But I'm guessing there are some strict conditions.
You're absolutely right.
That have to be met before a smaller bank can take advantage of that higher lending limit.
First,
Okay.
the board of directors has to formally approve that higher limit
Right.
through a specific annual resolution.
Okay.
And they can't just rubber stamp it. They need to provide a detailed justification
Okay.
based on factors like the bank's historical track record with insider lending
Okay.
and the need to attract and retain qualified directors.
So they need to demonstrate
Right.
that it's a prudent and necessary decision, not just a way to circumvent the rules.
Exactly.
Oh, else.
The bank also has to meet all applicable capital adequacy guidelines
Okay.
established by the federal banking agencies.
So they need to be in good financial shape
Mm-hmm.
and have a clean bill of health from regulators.
And to top it off,
Okay.
they need a satisfactory rating on their most recent examination report.
Makes sense. It's a balancing act
It is.
between giving smaller banks some flexibility
Mm-hmm.
while still ensuring safety and soundness.
Exactly. And it's important to remember that if a bank that has adopted this higher limit
Cool.
later fails to meet those capital requirements
Cool.
or receives a less than satisfactory rating,
Yeah.
they have to revert back to the standard aggregate lending limit.
So there are consequences if they slip up.
Right.
Examiners need to be particularly vigilant when reviewing those smaller banks
Yeah.
that are operating under that higher lending limit.
You got it.
Now, even with these limits in place,
Right.
there are certain types of extensions of credit
Yes.
that are exempt from the aggregate lending limit,
Right.
regardless of the bank's size.
For example, any extension of credit that is fully secured by obligations issued or fully guaranteed as to principal and interest by the United States or any of its agencies
Okay.
is exempt from the aggregate lending limit.
So if the loan is backed by rock-solid collateral,
That's right.
like U.S. Treasury securities,
Mm-hmm.
it doesn't count towards that overall limit.
It's all about mitigating risk.
Okay.
Loans secured by unconditional takeout commitments or guarantees from a U.S. government agency or state government are also exempt.
So it's about shifting the risk away from the bank. What other types of loans are exempt?
Loans secured by a segregated deposit account
Okay.
at the lending bank itself
Okay.
are also excluded from the aggregate limit.
Interesting. So if the bank essentially has control over the collateral,
Right.
it's not considered as risky.
Mm-hmm.
What about consumer loans?
Yeah.
Are those ever exempt?
There's a specific exception for loans that originate from installment consumer paper
Okay.
that the bank acquires from an insider, as long as that insider provides a full or partial recourse endorsement or guarantee.
Okay, so the insider is still ultimately responsible for repayment,
Exactly.
even though the loan is technically made to someone else.
But there are a few additional conditions that need to be met.
Okay, what are those?
First, the bank needs to have proper documentation on the financial condition
Of each individual borrower.
Okay.
Second, a designated bank officer has to certify in writing that the bank is relying primarily on the borrower's ability to repay, not just on the insider's guarantee.
So it can't be a sham transaction
Got it.
designed to get around the aggregate lending limits.
And the final condition is that the borrowers themselves can't be insiders.
Okay.
This prevents a situation where the bank is essentially lending to a group of insiders through a series of consumer loans,
Okay.
disguised as arm's-length transactions.
That's a lot to keep track of.
It is.
But it sounds like these exceptions to the aggregate lending limit
Right.
are designed to accommodate legitimate business practices
Exactly.
while still maintaining safeguards against abuse.
It's a delicate balance.
Okay, now let's talk about overdrafts.
Okay.
Always a bit of a headache for examiners.
Overdraft.
What does Regulation O have to say about them?
Regulation O imposes a general prohibition.
On member banks paying overdrafts for executive officers and directors.
So if you're a high-ranking bank official, you can't just accidentally overdraw your account
That's the general rule.
and expect the bank to cover it.
But of course there are exceptions.
I figured as much. All right, let's hear them.
First, if the bank has a formal, written,
Okay.
pre-authorized, interest-bearing overdraft protection plan in place,
Okay.
they can cover overdrafts.
So it has to be a legitimate plan,
Right.
not just a wink and a nod from the teller.
But it has to be a legitimate plan, not just a wink and a nod from the teller.
What's the other exception?
The second exception is for pre-authorized transfers
Okay.
from another account owned by the same person at the bank. Think of it like having your checking account linked to your savings account
Right.
for overdraft protection.
Okay, so those are the two main exceptions.
Right.
What about those small accidental overdrafts? Surely there's some leeway there.
There is. If an executive officer or director accidentally overdraws their account by $1,000 or less,
Okay.
and they repay that overdraft within 5 business days,
Okay.
the bank can cover it without running afoul of Regulation O.
That seems reasonable, but there's a catch, right?
You're absolutely right.
The bank can't just waive the usual overdraft fees.
The bank is required to charge the same overdraft fees.
Okay.
That would apply to any other customer in a similar situation.
No special treatment for insiders.
Right.
Even for small overdrafts.
Okay, so we've covered the basic rules for overdrafts.
Right.
Are there any other nuances that examiners should be aware of?
Fill me in. What else should we be looking for?
Yes, a couple of important points to keep in mind.
Okay.
This overdraft prohibition only applies to executive officers and directors of the member bank itself,
Okay.
not to those of its affiliates.
So a bank could potentially pay an overdraft
That's correct.
for an executive officer of an affiliate company
Right.
without violating Regulation OO.
And this prohibition also doesn't apply to principal shareholders
Okay.
unless they're also serving as an executive officer or director of the bank.
So there's a bit of a loophole there for principal shareholders who aren't directly involved in the bank's management.
Right.
What about related interests?
good question.
Does this prohibition extend to them?
This overdraft rule doesn't apply to the related interests of insiders.
So a bank could potentially pay an overdraft
Exactly.
on an account owned by a company controlled by an insider.
Examiners need to be very aware of these nuances and scrutinize any overdraft activity that involves insiders or their related interests.
Yeah.
Don't just assume that all overdrafts are prohibited.
Right.
You need to dig deeper and analyze the specific facts and circumstances.
All right. I'm definitely starting to appreciate the complexity of these general prohibitions.
It's a lot to keep track of.
It is.
But I can see how it all comes together to prevent insider abuse and protect the bank.
No.
You're absolutely right.
Before we move on
Yes.
to some of the other important sections of Regulation O, let's take a moment to recap
Okay.
what we've covered so far.
All right. All right. So you ready to dive back in?
Let's do it.
Let's recap those key points of Regulation O that we've already covered.
Okay.
We started by laying the foundation with Section 215.1, outlining the legal basis, purpose, and scope of the regulation.
Right. The bedrock.
And then we dug into those critical definitions in Section 215.2,
Right.
making sure you understand the precise meanings of terms like affiliate, control, executive officer, and insider.
Yeah, it's all about speaking fluent rego.
Exactly. And all essential for examiners, right?
Oh, absolutely. Got another lingo.
We also tackled Section 215.3, defining what constitutes an extension of credit.
Right.
And those scenarios that examiners need to watch for.
Yeah, we learned that it's not just straightforward loans.
Yeah, but
it encompasses a much wider range of transactions.
it does. Like,
Repurchase agreements, letters of credit, even advances on unearned compensation.
Yep.
And, of course, we just finished dissecting those general prohibitions outlined in Section 215.4. These rules ensure fairness and transparency in insider lending,
right.
focusing on key areas like terms and creditworthiness,
Yep.
board approval thresholds, individual and aggregate lending limits, and those tricky overdraft rules.
You got it.
So much good stuff already.
Right.
I know there's more to Regulation O
There is.
than just those 4 sections.
Yes.
What else should examiners be aware of?
Let's move on to Section 215.5.
Okay.
This one adds even more restrictions, specifically for loans to a member bank's own executive officers.
Okay.
Keep in mind, this section doesn't apply to executive officers of affiliates,
Yep.
just the bank itself.
Okay, so even more scrutiny for those at the very top.
Exactly.
What do these additional restrictions focus on?
This section limits the specific reasons.
Okay.
A member bank can extend credit to its own executive officers. There are 4 authorized purposes
Okay.
spelled out in the regulation.
All right, let's break those down one by one.
Okay.
What's that first authorized purpose?
The first one is straightforward,
Okay.
financing the education of the executive officer's children.
Okay, so banks can help their executives pay for college tuition. What's the second authorized purpose?
The second one is financing or refinancing,
Okay.
the purchase, construction, maintenance, or improvement of the executive officer's primary residence.
Okay, so the bank can help their executives buy or fix up their homes.
Yes.
Are there any limitations on that?
There are a couple of important conditions that have to be met.
Okay.
First, the loan must be secured by a first lien on the residence.
So no second mortgages or home equity loans?
Nope.
To fund a lavish vacation home?
And second, the executive officer must actually own the residence, either before the loan is made
Okay.
or right after.
So it has to be their primary home,
Right.
not some investment property.
What if it's a refinancing?
Yeah, are there any special rules there?
Yes. If the loan is for refinancing,
Okay.
the amount of the extension of credit can't exceed the amount outstanding on the existing loan,
Okay.
plus closing costs and any additional funds used for those specific purposes,
Yeah.
purchase, construction, maintenance, or improvement of the residence.
So it's pretty tightly controlled.
Right.
What's the third authorized purpose for executive officer loans?
This one is a bit of a repeat.
Okay.
It covers any extension of credit
Okay.
that's secured in a manner described in Section 215.4 D3 IAA through D3AC.
Okay.
Remember those exemptions we discussed earlier related to the aggregate lending limit?
Right. Those were the exemptions for loans backed by U.S. Treasury securities,
Exactly.
obligations guaranteed by the U.S. government, or a segregated deposit account at the bank itself.
So if a loan to an executive officer meets one of those exemption criteria,
Yeah.
it's also permitted under this section.
Okay. Consistency is key.
Consistency is key.
All right. That makes sense. What's the fourth and final authorized purpose for executive officer loans?
The fourth one is a bit broader.
Okay.
It covers any other purpose that's not specifically listed in the previous three categories.
Okay, so some flexibility there.
Right.
But I bet there are some limitations or conditions attached to this other purpose category.
Yeah, you bet there's a limit on how much an executive officer can borrow for these other purposes.
Okay.
The total amount can't exceed the greater of 2.5% of the bank's unimpaired capital and surplus,
Okay.
or $25,000.
Okay.
And there's an absolute cap of $100,000.
So there's a ceiling to prevent executives
Yes,
from using the bank as their personal piggy bank
exactly.
for things like speculative investments
Right.
or lavish vacations.
Besides those four authorized purposes, are there any other conditions or requirements?
Yeah. Fill me in. What else should we be looking for?
Transparency is key.
Okay.
Any extension of credit to an executive officer has to be promptly reported
Yeah.
to the bank's board of directors.
Good to know.
No hiding these loans under the rug.
What about terms and creditworthiness?
Absolutely. No special treatment for executives.
Okay.
The loan has to comply with the same requirements for terms and creditworthiness that apply to all insider loans.
Same interest rates, collateral requirements, underwriting standards,
Exactly.
all that good stuff.
The executive officer also has to provide the bank with a current, detailed financial statement
Okay.
before the loan is made.
So the bank needs to have a clear picture
Right.
of the executive's financial health before extending credit.
Makes sense.
Makes sense. Anything else?
One last thing.
Okay.
The loan agreement can include a clause
Okay.
allowing the bank to demand immediate repayment
Okay.
if the executive officer's total outstanding debt to all institutions exceeds those specific limits we discussed earlier
Right.
for each loan category.
So it's like a safety valve
You got it.
for the bank to protect itself
Right.
if the executive gets overextended.
It's all about managing risk and ensuring that these executive officer loans are handled prudently.
Right. I think I have a good grasp on the specific rules for executive officer loans now.
Good.
What's next on our Regulation O tour?
Let's quickly touch on some other notable sections,
Okay.
just to give you a well-rounded understanding of the regulation.
Sounds good.
Section 215.6 is pretty straightforward.
Okay.
It prohibits insiders from knowingly receiving
Okay.
or allowing their related interests to receive
Mm-hmm.
any extensions of credit that are not authorized by Regulation O.
So it puts the onus on the insiders themselves
Exactly.
to make sure they're not breaking the rules.
No pleading ignorance here.
No pleading ignorance here. What about 215.8?
215.8, which stresses the importance of record keeping.
Okay.
Member banks need to maintain thorough and accurate records to demonstrate compliance with Regulation O.
Record keeping.
Right.
The lifeblood of a good exam.
The lifeblood.
What are the specific requirements here?
The regulation requires banks to have a system in place
Okay.
to track all insiders,
Hmm.
both for the bank itself and its affiliates.
Okay.
They need to keep records of all extensions of credit to those insiders,
Okay.
including the amount, terms, and any other relevant details.
So examiners should be able to easily trace the flow of funds
Yes.
and verify that the bank is following the rules.
What about those exemptions for affiliate lending?
Right. Do banks still have to keep records,
Absolutely.
even if a loan is technically exempt?
The exemptions don't give banks a free pass on record keeping.
Okay.
They still need to document those transactions
Yeah.
and be able to show why a specific loan qualifies for an exemption.
Okay, so no cutting corners on documentation,
No cutting corners.
even for those exempt transactions.
What else should we know about?
Yeah, what else is there?
Section 215.9 deals with public disclosure requirements.
Okay.
Member banks are required to make the names of
Okay.
their executive officers and principal shareholders
Mhm.
available to the public upon request
Okay.
if those individuals
Mm.
or their related interests
Okay.
have received extensions of credit
Mm-hmm.
that exceed certain thresholds. So there's a transparency element built into the regulation.
Yeah, the public has a right to know
They do.
about these insider dealings,
Right.
even if they don't get all the nitty-gritty details.
The bank doesn't have to disclose the specific loan amounts or terms,
Okay.
but they do have to reveal the identities
Mhm.
of the insiders involved.
Okay.
And of course, the bank needs to keep records of those disclosure requests.
Okay, so more paperwork for the bank.
Right.
But it's all in the interest of public accountability.
It is.
All right, what's next?
Section 215.6 has a specific reporting requirement
Okay.
for executive officers and directors of non-publicly traded member banks. These individuals are required to annually report to the board of directors any outstanding extensions of credit they received from the bank that are secured by shares of the bank's stock.
Ah, so another layer of transparency.
Right.
Specifically for those banks where the stock isn't publicly traded.
Makes sense.
Makes sense. Now, what about penalties?
Yeah.
What happens if a bank or individual violates Regulation O? Are there any consequences?
You bet there are. Section 215.11 outlines the civil penalties
Okay.
that can be imposed for violations. The penalties can be pretty substantial.
Good.
So banks definitely have a strong incentive to make sure they're in compliance.
Nobody wants to see banks cutting corners
No.
or taking advantage of their position.
Any final points to cover before we wrap up?
Yeah. Is there anything else?
Just a quick reminder that Regulation O applies to savings associations as well.
Okay.
Section 215.12 clarifies this point.
Mm-hmm.
The rules are essentially the same. Although the calculation of unimpaired capital and surplus might differ slightly
Okay.
based on the specific regulatory capital rules that apply to savings associations.
All right. So Regulation O casts a wide net,
It does.
covering a wide range of financial institutions and transactions.
It's undoubtedly a complex regulation,
It is.
but I feel like we've broken it down into manageable pieces
Yeah, absolutely.
and highlighted the key points that examiners need to know.
As a final takeaway,
Yes,
remember that the financial world is constantly evolving.
it is.
New products and services emerge,
Mhm.
and regulators may update interpretations of existing regulation.
When they may.
So it's critical for examiners to stay current
It is.
on the latest guidance from their agencies
Absolutely.
and any relevant legal developments.
Don't just rely on what you learned years ago.
Right.
Keep learning.
Yep.
Keep asking questions
Mhm.
and stay engaged with the evolving regulatory landscape.
Excellent advice. Well, we've certainly covered a lot of ground today.
We have.
Any closing thoughts for our listeners before we sign off?
Just remember that Regulation O is ultimately about ensuring fairness,
Uh-huh.
transparency, and sound risk management when it comes to insider lending.
Yeah.
By understanding the intricacies of this regulation, examiners can play a vital role in protecting the integrity of the banking system
Absolutely.
and maintaining public trust.
Well said. And to all our listeners out there,
Yes,
thanks for joining us on this deep dive into Regulation O.
we appreciate you listening.
We hope you found it informative
Yes.
and maybe even a little bit enjoyable.
And to help you solidify your knowledge,
Okay.
we've put together some quiz material
Perfect.
that covers all the key points we've discussed.
Awesome.
We encourage you to take the quiz, test your understanding,
Yeah.
and make sure this information really sticks.
Until next time, happy examining.